Hello, 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 and welcome back to yet another live event where we unpack underwriting and multifamily investing one step at a time. For those who may be tuning in for the first time, my name is Bessie Kapulian, former commercial lender turned real estate investor, and today I work with high achieving professionals, family offices, where I connect them to well vetted cash flowing investments in apartments. And for investors willing to do a deeper dive, I also have a course and community that helps them learn how to evaluate deals from beginning to end with confidence and ease so they can protect their capital. And lastly, I also, for those who are busy and don't necessarily have the time or desire to be doing a deeper dive, I also help with one off deal reviews, helping them navigate through the complexities of the deal structure and the underwriting. I usually go live on Thursday afternoons, but due to travel, I had to make some scheduling changes. But I am committed to all of you and each and every one of you. So I wanted to show up at least for a couple of minutes today and share my thoughts on some recent news that I came across. Some making the headlines, others not so much, but as always, looking to distinguish the signal from the noise. And one particular article from Globe Street mentioning that the maturity wall moves to 2026 as loan extensions pile up. Now, this wasn't necessarily surprising, but if you recall at the beginning of the year, everyone in the multifamily world, really in the commercial real estate world, was talking about the wave of loan maturities that were pushed out from 23 and 24 into 24 and 25. And so a lot of investors expected that with loans now due, owners would have to take action, and that assumption was predicated on another bigger, or that expectation rather was predicated on the assumption that the lenders would not want to extend those loan facilities. With that said, a lot of the loans were maturing in the second half of the year, and we didn't really see a lot of activity in the first half. And I can tell you, as a former lender, typically you wouldn't wait till the 11th hour to discuss a loan extension or a loan maturity. All of that suggesting that these loans are likely getting modified and extended. And that's exactly what the article confirmed. This is no longer an assumption or hypothesis, but it's a fact. And so a lot of the loan maturities, which were about 780 billion in commercial real estate, that were expected to come off this year, and some have, but the number for 2026 is increasing to almost a trillion. So it's more like 940 billion dollars, which is higher, not necessarily lower. That number stays in that range for 2027 and increases further to a trillion in 28, 29, and 2030. And what a lot of investors thought is that these delinquencies that have been rising and increasing, a lot of the distress that owners are going through will trigger these capital events. But on the other hand, lenders are also being patient and choosing to work with the borrowers who have maintained good behavior, who are still able to make their debt payments and also have deep pockets to infuse the deal with additional capital. So we haven't seen the flood of quote unquote distressed owners or distressed deals hit the market. There have been several, but not as many as investors anticipated. And when it comes to delinquency in particular, what's important to remember is that depending on the loan provider, delinquency is defined differently, right? In the CMBS world, anything that's 30 days or more past due falls in that bucket. And with some of the regional and national lenders, that could be 60 or 90 days past due. So naturally you see the delinquency numbers being lower in the traditional lending world and maybe a little bit higher in the CMBS portfolio or the CMBS stats when those typically get released. But there was one piece of news. So if you're in the banking or lending markets, you probably saw that, and it made the headlines, but not so much in the traditional news channel. But there was a new banking regulation that was passed just a few weeks ago, or just a couple of months ago, not too long ago, which basically changed how um, uh, modified loans will be defined and how they will be reported. And just to read verbatim, under the new changes, which actually take effect this year, banks will no longer have to report modified loans after 12 months. And so what that means is that you may have a loan on the book that has been perhaps distressed, modified, going through duress. But if it remains as such for more than 12 months, it will have to drop off that category, which then creates less transparency, especially for banks who choose to adopt this particular rule early. And calling it distress forever is probably on the extreme side of the equation, but also dropping it off the reporting books and channels from the distress category only after 12 months is probably the other extreme side of the spectrum. The solution is probably somewhere in between. All that to say is that the quote unquote distressed loans and distressed type of data will be a little bit more murky going forward because of this new regulation. And so what I see in terms of investor, there's a lot of investor appetite for good assets. And on my end in particular, I'm continuing to evaluate opportunities, not necessarily looking at distressed deals per se, but probably distressed owners, operators who have unfortunately ran out of cash, who have been under duress for a while, and who are facing a capital event, typically loan maturity, and a situation where the lender is no longer willing to work with them. These are situations that are creating some urgency for the seller to act, and perhaps more willingness to work with a potential buyer, where that price discovery, which is still ongoing, maybe not to the same extent as in 2024, but still ongoing in 2025, gets compressed a little bit when you have these special circumstances or other drivers for sellers to take action. But overall, the sentiment, at least for across a lot of my peers and the people with the dry powder, people who have the dry powder, is that powder will likely stay dry for longer than expected. And there's another article by Globe Street that emphasized exactly that point, that investors are now even more disciplined than ever, especially those who have been through the 0809 cycle, the COVID cycle, and as of late, the post-COVID um, uh, situation and transition, the downturn that we're going through, at least in commercial real estate right now. And I'm personally optimistic about the state. I'm specifically focusing on multifamily as part of the larger commercial real estate universe. I'm personally optimistic about the longer term prospects of the sector, but because of everything else happening in the industry, even when these deals come across, unless they're priced appropriately, it's still a reason to pause and at least ask the question, is that worth the risk? Not only the investment risk, but the illiquidity risk. And that's created, at least on my end, a lot of tough decisions where I've come across deals with amazing operators in great markets. But when you underwrite the deal under the current market environment and reality, so not factoring in cap rate compression, not factoring in excessive rent growth, being more thoughtful about inflation, which has caused a spike in expenses, and particularly insurance being a big one across many geographies within the US, but other factors as well, like costs of materials and labor. When you factor all of that in, and then the higher cost of capital, higher cost of debt relative to where we were a couple of years ago, naturally that creates a very different cash flow picture, therefore very different valuation and overall return of the property. So we will weather the storm. That too shall pass, as they say. But it's important to be disciplined in this current environment. And I know a lot of lenders are of the same mindset. A lot of investors are of the same mindset, and there will be more for sure to follow in 2026 and 2027. But I wanted to pop up very quickly and share my thoughts on some of these events and articles that I came across that I found interesting, that are also, I think, quite relevant for the space, and also some of the analytical process and thought process that I go through and my investors go through as we evaluate opportunities together. At any rate, if you would like to be notified of future events or master classes, you can follow me on LinkedIn and YouTube, where I go live once a week, and I also post on LinkedIn daily. And if you'd like to do a deeper dive on multifamily underwriting, you can message me directly. I do have a very exciting announcement that I will be sharing very soon. So tune into the next one to find out what that is. And also next week, on November 12th at 5 p.m. Pacific, I have the pleasure of hosting Pat Zingarella from Invest Clearly, which is a great resource for passive investors to tap into as they perform their due diligence on the sponsor. So I will post the link to that in the comments of this live event, but you can also DM me directly if you'd like to register. The event is complimentary to join, and I know it will be a lot of fun, and we'll learn a lot together, while also having fun. So this is all for today. I wish you an amazing weekend, and I will see you at the next live event. Ciao.